Welcome back to the AP test review. Now we're going to talk about Unit 4, monetary policy. First, we're going to start with a quick review of the money market. Alright, so remember, monetary policy is conducted by the Fed, and the graph that goes with monetary policy is the money market. So on your x-axis, remember we're going to have the quantity of money supply. On the y-axis, just a nominal interest rate or price of borrowing money right now. If I were to walk into the bank right now and ask for a loan, they'd tell me an interest rate. That's my nominal interest rate. The interest rate that isn't adjusted for inflation. The real interest rate does adjust for inflation. The money supply curve is vertical, and that's because the Federal Reserve controls the money supply. Our central bank has monopoly control on the money supply, and they have three tools for changing it. First tool is open market operations. That's when the Fed either buys or sells bonds. Second tool is the discount rate. That's the interest rate that the Fed charges commercial banks to borrow money from the Fed. And the third tool is the reserve requirement ratio. That's the amount of money that's in demand deposit or checking accounts that banks have to hold on to required by law, and that amount is set by the Federal Reserve. Our money demand curve is downward sloping because as the nominal interest rate decreases, we want to keep more of our own money in our pockets or spend it because our opportunity cost for spending our money or holding our money outside of a bank is decreasing. The opportunity cost for spending your own money or keeping your pockets is the interest that you could be earning by leaving it in some sort of interest-bearing asset like a bond or a savings account or certificate of deposit. So as the interest rate decreases, we're missing out on less interest payments, so we're more likely to spend. As the interest rate increases, we're missing out on greater and greater interest payments, so we're more likely to save our money. First, we're going to talk about how the Federal Reserve could correct a recession. In a recession, our big problem is high unemployment. So the goal of the Federal Reserve is going to be to try to get people to spend money again and increase aggregate demand and shift it to the right. If we want people to spend money again, what we need to do is increase the money supply. When we increase the money supply curve will shift to the right. Now there's an increased amount of money in the banking system and in the economy. That's going to cause our nominal interest rate to decrease. And like we said, our money supply curve to increase. There's three ways the Federal Reserve could do this. The first and most likely thing they would do is open market operations. That would be to buy bonds. Buy bonds, big money. They go up to banks. They're going to go up to banks that hold government debt, buy that debt back from them, and hand them cash. That increases the money supply, and the banks can lend that money out. They could also lower the discount rate. If the Federal Reserve wants banks to lend out every cent that they can, then they'll charge commercial banks a lower amount of money to borrow from the Fed. And finally, they could change the reserve requirement ratio. If the Fed wants banks to lend out more money, they can lower the reserve requirement ratio, and now those banks won't have to hold on to as much money out of people's demand deposit accounts. The money supply increases, shifts to the right. Now, our opportunity cost for holding cash in our pockets is now lower. I'm not missing out on very much interest payments when I spend my money or walk around with it in my pocket, so I'm more likely to buy things. When that happens, aggregate demand will increase and shift to the right as we're buying more stuff. PL2. And now our unemployment rate is decreased. So our GDP is increased, making our unemployment rate go down. The only problem here is that our inflation rate is going up. So because this is a short run effect, wages are sticky in the short run, price level goes up, but I'm still making the same amount that I used to. My real wage is going to go down, but that's not the end of the world because our unemployment rate is going down as well. Now that the interest rate has gone down, the price of previously issued bond prices will go up. Remember, there is an inverse relationship between bond prices and the interest rate. So when the interest rate goes down, previously issued bond prices go up. Remember, if you hold a bond, you actually own someone's debt. So you would rather own someone's debt at a higher interest rate. So now that the interest rate is lower, rather than get a new bond issued, I'd rather go buy an old bond that was created back when the interest rate was higher so I can get higher interest payments. In an inflationary gap, our problem is high inflation. Prices are getting too high. So the goal of the Federal Reserve is to decrease aggregate demand and get people to spend less money. And so in order to do that, they're going to have to decrease the money supply. In order to do this, the Federal Reserve has three tools. The most likely thing the Fed will do is sell bonds small money. Basically what they do is they go to banks, sell a piece of paper to them that says that the government owes them money, and take money out of those banks, and now that money can no longer be lent out. So sell bonds small money, money supply decreases and shifts to the left. They could also raise the discount rate. If the Fed doesn't want commercial banks to lend out every last dollar that it can, then they'll charge them more to borrow from the Fed. Finally, they could also increase the reserve requirement ratio. If they increase the reserve requirement ratio, now banks have to hold on to a greater percentage of money in people's checking accounts and can't make out as many loans as they could before. So all of those things will cause the money supply curve to shift to the left. We'll have a decrease in the money supply, and the nominal interest rate goes up. Now that the nominal interest rate is increased, the opportunity cost for spending our own cash is getting greater. Now that the opportunity cost for spending my own cash has gone up, it's more lucrative to put my money in a savings account than it is for me to spend it. And so now the interest rate is higher, that's going to cause me to want to spend less money. Also, the interest rate is higher and it's going to cost more to borrow money. Aggregate demand decreases, shifts to the left, and that drives down our price level. The unemployment rate goes up a little bit, but we still are at the natural rate of unemployment, so that's not that big a deal. But the price level will come down, which is what we wanted. We wanted inflation to decrease. And remember, there's an inverse relationship between the interest rates and the prices of previously issued bonds. So now that the interest rate is higher, the price of previously issued bonds is going to go down. I don't want to buy these old bonds because I could get a new one written out at a higher interest rate and get higher interest payments back to me. Before we go, I also want to touch on bank balance sheets real quick. Okay, we got two sides to it. We got liabilities and assets. Liabilities are something that you own back to someone else. So the demand deposits, the money in people's checking account, is a liability for the bank because eventually those people are going to come in and they get to have it back. Assets are going to be something you own that can make you more money in the future. So loans are an asset for a bank because they're going to get it paid back at some point. And the reserves are an asset for a bank because they're potential loans. Now, let's break this down. Remember, the most important part of a bank balance sheet is the demand deposits because everything else is dependent upon it. We got $100,000 in demand deposits or people's checking accounts. The reserve requirement ratio is 10%. The Fed has told this bank and other banks in this country that they have to hold on to 10% of any dollar that's in the demand deposits account. So they have to hold on to 10% of that $10,000. That is $10,000. So this bank is required by law to hold on to $10,000. They are currently holding on to $20,000. And remember, this is a bank balance sheet, so it balances. The money that's in the demand deposits is the money that's lent out. So out of that $100,000, $80,000 has already been lent out. And it also, the demand deposit money is also the money that's in the reserves. So out of this $100,000, $80,000 has been lent. $20,000 is actually still sitting in the bank. According to the Fed, this bank has to hold on to 10% of that $100,000, which is $10,000. So they currently have $10,000 in their excess reserves. $10,000 that they can do with what they want to do with it, and what they are allowed to do with it is loan it out. So if this bank were to lend out every dollar that it's allowed to and lent out the $10,000, and every single person that came into this bank and took the loan out put the money back in their own checking account and their banks lent it out over and over and over again, then there's going to be a greater increase to the money supply than just the initial loan of $10,000. So we need to take our RRR and figure out our money multiplier. The money multiplier formula is, I'm going to write it out here, money multiplier, and the formula is 1 over the RRR, and right now, so it's 1 over the reserve requirement ratio, or 1 over the RRR, or maybe, right now that's 1 over 0.1, and 10 cents goes in $1.10 times. So, our money multiplier is 10. The bank lent out $10,000. They could increase the money supply by up to $100,000. Couple things to keep the money supply from increasing by that entire $100,000. One thing would be if someone just doesn't put their money back in a checking account. If it's not in a demand deposit account, the bank can't lend it out. The other thing could be if it gets deposited into a bank that doesn't want to lend all of its excess reserves. That's been a quick overview of Unit 4, monetary policy. In the next video, we'll talk about stabilization. Goodbye.